Coming up on today's show, Google and AMD missed data center revenue and what it means for the market. Will we get an inflation resurgence with tariffs? The current earnings situation after Google's miss and why this chart should concern you. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were mixed on Wednesday as earnings from Alphabet, AMD and Uber fell short, though big tech got a boost from a jump in Nvidia shares. And yeah, stocks were mixed, but that was mostly because of the big names in the index. Other than that, we saw like amazing breath. Some would say breath of fresh air. Microsoft and Apple were kind of on the flat line. There was a probe released into Apple and that's why they were down today. Microsoft up ever so slightly, but the other names, Amazon and Tesla, were down very big here today. Tesla on the eve of its earnings, and then Google was down 7% on the back of its earnings. Meta was flat as well, literally down 0.2%. Nvidia, AVGO, and semiconductors as a whole were up except for AMD. Again, that had to do with its earnings. Uber was also down 8%, but software as a whole, semiconductors as a whole was just very green today, bouncing in a very big way. We also saw green here in financials across the board. Same too with healthcare on the back of Novo Nordisk's earnings. Real estate was green, utilities was green, industrials was green, consumer defensives was green. I mean, excluding the mega cap names, we actually saw a very green day across the board. Look, XLY, Amazon and Tesla, XLC, Google down 1.08 and 1.3% respectively. Every other sector was green. XLB, materials, industrials, energy, staples, right? They were all very positive today, and sectors gaining more than 1% or just around 1% was financials, healthcare, utilities, technology, and real estate. In fact, technology, real estate, utilities were well above 1% today. Very strong momentum. Now, gold was up 0.7%. That had to do with the movement in the dollar. We're going to talk about why and how that relates to economic data a little bit later on. And the SPY was only up 0.32%, and that's because of the weight in these sectors right here. These are two very big sectors, held the SPY back, but we still saw positive momentum net. We actually saw the best momentum in the market come from small caps and mid caps, right? Especially the growth and core parts of these markets. So investors really taking up growth risk, especially in the mid-cap and small-cap space. In fact, I wouldn't really say mid-cap space. Mid-cap companies are actually like fantastic companies, particularly the S&P 400. You gotta index the S&P 400, right? Growing at 17% year over year, and it only trades at something like a 17 forward PE or 16, something ridiculous like that. So a lot of value to be had right here. In smalls as well, you got to do a bit more research to find those quality companies. But the market realizing that if rates do come down, if the dollar does ease, and if we do get some of these trade tensions settled, these stocks are going to benefit the most, particularly with their earnings and valuation. And that's why we did see that rotation into these names. But we also did see a rotation here into large cap value. And guys, this is all on a relative basis because every single sector was positive today. I mean, large growth, large core, small cap value, mid cap value were just positive. It's just that these sectors right here, a large cap value, mid cap growth and core, small cap growth and core, were just outperformers relatively speaking. Now, mid caps and small caps actually fell because the dollar pulled back in a very big way, and we also saw yields move lower sharply. And the reason why that happened had to actually do with the economic data we got today. Now, number one, the ADP numbers came in 183 versus 154 forecasts. That bodes really well for NFP. So the labor market, at least the private labor market, that's what ADP is, looking very robust, and again, bodes well for NFP. Then we actually saw some of the ISM manufacturing data. Now, the services sector continued to expand in January. That's by reporting numbers over 50. However, it was at a slower pace than in private months. Now, US services PMI came in at expectations. ISM services came in slightly below expectations. However, still above the 50 mark and still an expansion month over month. We also got a ton of Fed speakers here today, and the Fed officials coming up and saying in light of Donald Trump Trump's new tariffs, they're not going to change their stance or change anything in regards to that. They're just going to react to the data as it comes. Fed Vice Chair Philip Jefferson said, "I do not think we need to be in a hurry to change our stance." Fed Chair Mary Daly said, "We do not need to be preemptive." A Richmond Fed president said that you want to wait and see. Now let's talk about some single stocks and market movers. Google was down 7%, nearly 8% today. Very, very crazy. And the stock was under pressure due to its cloud revenue. It actually undershot estimates. You can see here that cloud revenue actually missed markets' expectations, and this kind of rattled investors. However, we actually saw revenue come largely in line. Earnings per share beat, advertising revenue beat, and operating income. But their cloud business is their fastest growing segment right now, and to miss on that means the stock as a whole is going to get punished. AMD was also down nearly 8% as well. And while AMD did provide a quarterly revenue beat, it disappointed in data center sales. Data center sales missed right here. And again, its fastest growing segment missed. That's going to rattle sentiment. However, it beat on revenue, it beat on earnings per share, beat on gaming revenue, and beat on client revenue. But data center is where they want to see the growth, and they're simply not seeing that. Now, another stock that was down 8% was Uber. They reported fourth quarter earnings with strong growth. Gross bookings rose 18%, revenue grew 20%, adjusted EBITDA jumped 44%. However, the stock fell around 8% due to its operating income. It came in at $770 million. It missed estimates, which expected it to come in at $1.21 billion. Now, this was due to legal, tax, and regulatory costs. Also, Q1 guidance disappointed, impacted by, they said, currency fluctuations and external events like the LA fires. Now, EPS was 23 cents, missed the consensus of 48 cents. And despite the dip, however, Uber saw record user growth, trips, and bookings, with the CEO emphasizing long-term expansion. There was a lot to love, a lot to hate about this. They missed on financial metrics, but everything else was really, really good for Uber. Nonetheless, I think the stock is going to digest everything because it did miss on earnings. It actually did get really expensive, but I'm a buyer at the 60 range. Let's see if this continues lower throughout the next quarter. Now, regardless of the winners and losers, what we actually did see for the third day in a row is net inflows, both in the NASDAQ and the New York Stock Exchange. We saw net inflows from the get-go, even as the market was in dangerous territory right here. The S&P 500 was actually negative, up now on the day, but the S&P 500 at this point right here was negative. We still saw net inflows, and that was probably the signal for you to get long, trying to take advantage of the alpha and the spread we saw right here. Very interesting trade. And then as net inflows started to trend down and sideways, we actually saw the S&P 500 trade sideways as well. We also saw market breadth expand in a very big way. The third day in a row now, nearly 4,000 advances, 2,300 decliners. And that's why stocks were largely positive today. And then looking at market momentum, guys, yesterday I said looking at market momentum, the shorter term, medium term, and longer term moving averages are all trending in the right direction. This is what you want to see in a bull market, and this is the type of momentum you want to ride until the end. So for those of you holding equities, keep doing that. Market momentum, market breadth, and market flows are all on your side right now. You don't want to fight this trend. This trend is strong. And looking at the charts, something I want you guys to know, look at the 2-year yield, the 10-year yield, and the 30-year yield, all moving down in a significant way. And that has to do with some of the trade tensions easing. Okay, they were very heightened on Monday, and there still is trade unease in the market. However, the market pulling back from those highs, particularly in the yields. We can also see the dollar pulling back. That also has to do with just some of the weaker than expected manufacturing data we got. Now, the pullback here in yields, the fall in yields as well as the dollar really just helped support equities. And we could really see, look at stuff like the RSP, look at stuff like the IWM and mid caps, right? Small caps, they're outperforming their large counterparts, NASDAQ 100, the S&P 500. It really goes to show that this is having a tangible effect on those names as a result. So, however, positive market momentum everywhere. The S&P 500 gained, small caps gained, mid caps gained. It's the second day of risk on momentum after that big Monday drop. Now, with regards to the dollar falling, we did see gold increase, so too did silver, just because they become a little bit more cheaper, relatively speaking, and the market bids them up. And then bonds did gain as a result. So bonds and equities continue to remain in a positive correlation. And then WTI was down 2%, nat gas up 3%. Very interesting trade. trade going on right there. But looking at the S&P 500, now we are at our second green day in a row. This was a red day here on Monday, but off the lows, very, very positive. We continue to do what we did last week. Was we had this massive volatility drop, and we continue to push now towards the 6100 area. Expect more of the same. Expect us to touch this area sometime before the end of the week, and expect this gamma flip zone hold as support if we do get here. All in all, buy dips, sell rips, aim for the 6100 area. That is our goal here in February. For the Nasdaq 100, it's exactly the same. Buy dips, sell rips, all dips at the gamma flip to be bought, aiming for the 2195 area. This is the core resistance or the core wall, and this is where we had some major highs. Now, this is looking like a higher low, relatively speaking. We got a high right here. That's a new all-time high. Higher low and higher low. What we really want to see with the Nasdaq 100 is push right above and actually break this high and then aim for new all-time highs. Because if we put in a fourth higher low, that's not looking good, relatively speaking. However, what is on the side of the bulls is that we did put in a low right here, and we didn't put in a lower low relative to some of these lows we put in, and that is positive. We put in an equal low right here, but we never did go ahead and break this low, and that is constructive, very constructive. And it goes to show that the DeepSeek situation as well as the tariff situation, at least for now, is very short term and should be short-lived. The RTY is pretty much at the scene of the crime, the core resistance, where we used it as resistance on multiple occasions right here, to a degree right here as well. The RTY needs to do here is break above, use as support, then make the next move higher, because we used it as resistance on multiple occasions. It now needs to turn that resistance into support and go ahead and break this 52-week high level and the new all-time high, which is slightly above it, especially on the index, the IWM, that's the actual ETF that's traded. But looking very constructive for us to go ahead. We just need one more day or 2 more days to push above. If we use it as resistance, that could spell trouble. However, we would still be in positive gamma, and we would buy the gamma flip, looking for us to go ahead and break this level. So that's the trade. If we don't break it right now, we probably go back to the gamma flip, and then we assess what happens next from there. But the IWM looking very constructive. So too does the RSP. This is looking like a very strong higher low relative to this low in the context of us forming a base and looking to move higher to all-time highs. This is very constructive price action, if you ask me, particularly if we just zoom out. Yeah, we did make a couple of lower lows, but we did put in a higher low here, and this was a key pivotal low which boosted us to this all-time high right here. So what we're going to see in the RS is if we hold this level right here, particularly this 178 level, we hold this level and then onward and upward to see new all-time highs. Looking very constructive. All of these indices are very key levels. The RSP looking to make its next move, the RTY looking to make its next move, and the S&P 500 and Nasdaq 100 slowly doing its thing, making its way to the core resistance. That's the type of stuff you want to see in bull markets. And there's not much to say here, guys, besides just buy any dips we do get and just stay long. Market momentum and market breadth is on our side. Equities continue to just grind higher. This feels like very mid-cycle price action where we get dips, grind higher, dips, grind higher, and we keep just making higher highs, higher lows. You love to see this type of price action. And this is the price action where you don't really do much. You just sit in your high quality names or the indices and you just watch the market make you money day after day. And you just have to sit through the volatility, embrace the volatility. Had you done that through this period right here or any of these volatile periods, right, you still would have been higher, and you still would have been richer net at the end of it all. So my advice to you guys in the year and now, embrace the volatility, buy the dip. Diving into sentiment, this is BOFA's bull bear indicator, and what we've seen over the last week is actually an uptick in sentiment. Now this indicator right here is largely based on technicals, stuff like market breadth, long only positioning, credit technicals. So it's really just a technical overview of sentiment, and it did tick up. And this was last week when we had the DeepSeek situation as well as all of the tariff news on Friday. So all of this bad news culminated in sentiment ticking up for the week, and that really goes to show that a lot of the angst, a lot of the market reaction was really just investors getting scared and just an overreaction based on sentiment, whereas the underlying technicals of the market was telling you that really all of this volatility is probably just a buy for us to go higher into the rest of the year. And that volatility is actually going to work its way throughout February, February in post-election years is actually the worst month in a post-election year. You can see an average return of 1.3%, and it's actually the worst month right behind August, September, and June. Now, February also has one of the worst hit rates, only at a 50% win. So it really goes to show, guys, that if we do get volatility here in the month of February, it's something to be expected, and you should really just buy the dip, because March, April, May tends to be very, very positive. Same with July, as well as the end of the year, and we actually get very solid hit rates. So embrace the volatility, take the opportunity, and don't forget about the fundamentals. Guys, I really want to talk about earnings season because it's not getting enough attention because the overreactions to earnings are. However, nominally, earnings are very good. We're looking at 12.1% earnings growth for Q4. The expectation coming into earnings season was for 9.6% growth. So we are smashing expectations, and the leaders are leading earnings: comm services, financials, technology, discretionary, real estate, healthcare, utilities. 7 of the 11 sectors are posting double-digit earnings growth for this quarter. The same is true here with revenue: 4.7% revenue growth, 77% of companies reporting above analyst expectations for earnings, and we're seeing a 6.3% earnings surprise factor, 1.2% here for revenue. You love to see this type of stuff. Now, one big risk to all of this is valuation. Yes, earnings are good, but valuations are elevated, particularly in US stocks. The S&P 500, the Nasdaq 100 are very richly valued. However, they do have the earnings growth to back it up. As you can see, this is consensus forward price to earnings multiple versus the expected EPS growth. I believe this is for 1 year, and you can see the S&P 500 is right here on this band, although a little bit on the pricier side. Generally speaking, on this side of the line, stocks are a little bit more pricey relative to their earnings growth. On this side of the line, stocks are actually a little bit cheaper relative to their earnings growth. So this is value, and up here you're paying up. Nasdaq 100 is right bang in the middle. So if you're looking between the S&P 500 and the Nasdaq 100, optically the Nasdaq 100 looks more expensive, but when you adjust for earnings and valuation, the Nasdaq 100 is a little bit cheaper, relatively speaking, but not by much. If you really are looking for value in the United States, look at the Midcap 400 and S&P 600. And I would really only caution investing in the United States right now, maybe Japan as well, simply because the US macro is just the strongest. I mean, look at the economic surprise index. We've seen the best surprises have been here in the US, South Korea, Australia. The global has actually seen net surprises, but really held up by these 3 countries, particularly the US. We've seen the worst surprises here in the Euro area, United Kingdom, the Euro area as a whole, Canada and Brazil. Japan and Russia have largely been flat. All in all, the place you want to be is the US, because that's where we're seeing earnings growth as well as just an overall robust economy. Goldman Sachs pegs US GDP at 2.5%, whereas they look at stuff like the Euro area at anywhere from 1 to 0.8%. So the US is really where you want to be. China at 4.5% revenue growth, but can you trust the figures? I don't know. The US manufacturing market is also turning up. We're seeing manufacturing expand for the first time since 2022. Employment, the labor market is very strong. We're near full employment. Federal bankruptcies are at some of the lowest levels ever, which is crazy. And now a big risk that everybody mentions is the inflation from tariffs, and that is true. PCE across 9 impacted tariff categories did see inflation increase in 2018, and those unimpeded by tariffs did actually see disinflation during the first trade war. However, I don't think this is actually going to lead to an inflation resurgence similar to the 70s, because in the 1970s, right, what really caused the inflation shock was energy CPI. Inflation in energy in the 70s was absolutely huge. Look at inflation energy today. We're actually seeing deflation, or actually disinflation in energy as a result. And this is where we are right now, right here. So unless we see a huge shock in something like energy or shelter, a huge component of CPI or food prices, I don't think we're going to see this like we did in the 70s. We may see a little bit of an uptick, but it's going to be relatively muted because we know there's massive shelter disinflation happening at the moment. Energy prices are probably going to stay where they are right now. Goldman Sachs see energy or crude at $80 a barrel at the end of the year. We're roughly at about 77. I don't think there's going to be a massive shock when it comes to food. So all in all, the US economy looking largely robust, the macro, the fundamentals, the technicals, everything looking great. And that is why, guys, you simply want to buy this dip and buy into the volatility. Now, 2025 is going to be a volatile year. February is going to be a volatile month. For those of you that embrace the volatility and will sit on your hands, you will do the best in 2025. And then looking at earnings for the rest of the week. Now, tomorrow is the final big day. Friday, not that big, but Thursday before the open, we have Eli Lilly, Roblox, ConocoPhillips, Peloton, Hershey's, BMY, Tapestry, after the close, Amazon, Elf, Cloudflare, Affirm, Fortinet, Microchip, Pinterest. So a big day tomorrow. So guys, still expect volatility and very much of the same for what we saw today. And then data for the rest of the week. Now, Thursday, we get initial jobless claims, non-farm productivity. Then we have a couple of Fed speakers. For initial jobless claims, what we're really looking for is a 213,000 to 215,000. That's what we're really looking at. I think we're going to get that initial jobless claims that's actually coming below expectations over the last couple of weeks, and then that leads us into non-farms, but we'll cover that in tomorrow's video. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.